In this video, I will provide a quick explanation of the capital asset pricing model, often abbreviated as CAPM for short. Now, this model uses the following formula to calculate the expected rate of return for a stock. We say R sub I is equal to R sub F plus beta sub I times R sub M minus R sub F. Now, in this formula, R sub I is the expected rate of return for some stock I. R sub F is the risk-free rate of return. So an example of that would be like a 3-month treasury bill. So it's an investment that is considered to have zero risk associated with it. Then beta sub I, that's the beta for the given stock. Now, that just means what is the stock volatility relative to the market volatility. Now, if a stock has a beta greater than 1, then that means it has a higher volatility compared to the market. If a stock has a beta less than 1, that means it has lower volatility compared to the market. And then lastly, R sub M, this is the expected market return. So typically we use a broad index fund like the S&P 500 to estimate what the expected market return would be. So let's take a look at an example of how to actually use CAPM. This says calculate the expected rate of return for a stock given the following data. R sub F is 3%, so the risk-free rate of return is 3%. Beta sub I, so the beta for this given stock is 1.5, and R sub M, the expected market return, is 10%. So according to the CAPM model, we can calculate the expected rate of return for this stock by saying R sub I is equal to R sub F, so the risk-free rate of return we're told is 3%. As a decimal, that would be 0.03. And then we add beta sub I. So beta sub I, for this stock, the beta is 1.5. So we'll say 1.5 times R sub M, so that's the expected market return. We're told to use 10% here. So as a decimal, that would be 0.1. And then we subtract the risk-free rate of return, so 3% again, which as a decimal is 0.03. So we get 0.03 plus 1.5 times 0.1 minus 0.03 is 0.07. So we get 0.03 plus 1.5 times 0.07. That turns out to be 0.105. And then if we add these two values together, that turns out to be 0.135, or as a percent, that would be 13.5%. So this is the expected rate of return based on the capital asset pricing model. Now, one thing that we can note is that higher values of beta would lead to higher expected rates of return. So for this example, this stock has a beta of 1.5, but we can imagine if this value was even higher, like if it was a 2.5 right here, this whole quantity would be bigger. So this whole quantity would be bigger and the entire expected rate of return would be bigger. So the higher the beta value, the greater the stock volatility and thus the greater expected rate of return. And that should make sense because higher values of beta mean more volatility or more riskiness, so an investor would demand a higher expected rate of return to be compensated for that risk. So that was just a quick example of how to use CAPM to calculate the expected rate of return for a stock.